Welcome back, everyone. This week I'm going to be going over what I've learned from 1 year of dividend growth investing. This is the method that I've chosen to grow my portfolio, and amidst all the craziness of last year, it has performed pretty well. So let's just jump right into it. So first, I'll go over some of the lessons I've learned in the first year of dividend growth investing to hopefully prevent you from making the same mistakes that I did, or to set you up for better returns right from the start. Now, don't think that these are going to be some kind of secret lessons that will make you wildly rich and make you have huge returns every single day, because that's not what it's going to be. It's going to be simple things that if you have been investing for a while, you probably already know, and it's just really to make sure to give you a better chance to avoid losing money right from the beginning. So the first lesson that I learned is that it's important to understand what you're investing in. When I first started investing, I had no idea what I was doing. The way I picked some things to invest in right at the start was either random companies that I liked or that I saw in a YouTube video. I had absolutely no idea how they were actually performing as a company, what kind of revenue they were producing, if they were growing or shrinking as a business, or any news that had come out recently. I bought Intel at $60 as my very first investment because I thought at some point they would announce a new chip that would raise the price up. Almost immediately afterwards, it fell $10 and continued to fall for the rest of the year. And I ended up selling this one at a loss right before it rose back up again, but whatever. I also bought these 2 shares of GE for the sole reason that I had $14 left in my account and could get 2 whole shares. I didn't even know fractional shares were a thing. Of everything I bought in the first month, the only things that I still have after all this time are VYM, VOO, Coca-Cola, and Realty Income. Everything else here I've sold because I didn't know what it was, and once I actually started doing some research, I didn't really believe in their potential. It wasn't until a few weeks in that I started doing some more research and bought into more companies that I actually understood a bit better. Even though there's still a lot of these, I still had no idea what they did. Pfizer I understood a bit better, and I bought it solely for the vaccine because I figured that they were going to come out first with one, which they ended up doing. But like Coca-Cola, I bought into again, and Bank of America, I understood a bit, and I knew that the banks were at a really low valuation, so I figured that this would be a good place to start buying in when they were a lot cheaper. The reason that I think that understanding your holdings is such an important lesson is the staying power that it gives you. If I truly believed in some of these companies that I bought at the beginning, I would have made really good returns because I could have kept buying into them as they dipped down. But I didn't do that because I didn't really believe in them because I didn't know what they did on a high level. Nowadays, since I've done a lot more research into all of my holdings, if any of them dip down, especially a lot, as long as the fundamental story of the company hasn't changed, I'm more than willing to continue to buy more into it as it dips lower and lower and lower. I'm not worried about the performance of any of these companies that I own now. If negative news does come out, then I'm able to quickly assess if it changes my long-term view of the company. If it doesn't, keep buying the dip. Like, no reason to sell it if I still believe in it long term. The second lesson I learned over this last year was to avoid chasing yield. Getting a huge yield can be really motivating, especially when you have a small portfolio like I did at the start. When I started investing, I picked a lot of these REITs that paid a lot of money, and these oil companies like ONEOK, which no idea what it did. Main Street Capital, they like gave loans or something to smaller businesses, but I didn't really know what they did. AT&T, which I believed in more than the other ones, but their story has fundamentally changed, which is why I don't hold them anymore. Like here with ExxonMobil, I bought it solely for the reason that it was a bit cheaper than it was before the pandemic, and that they had a really huge yield. It was like 8% at the time. But what I didn't really think about at the time was that it does just because it has a high yield doesn't mean it's going to be a good investment. All of these like a lot of these companies like ExxonMobil, uh, AT&T, and T, and Main Street Capital all had really high yields. They were all over 5%, with like AT&T being over 7, ExxonMobil being over 8. And while had ExxonMobil, at one point it had over a 10% yield because it dipped into the low 30s. But the growth rate of these dividends is extremely low. ExxonMobil's 5-year growth rate is 3.4% with their dividend. These all these numbers will be with their dividend. Main Street Capital's growth rate is 2.7%, and AT&T's is even lower at 1.7%. The problem with this is I don't need the dividend income now. I need it 20, 30 years in the future. So I want this to be able to grow more into the future when I actually need it more. It's much better for me to invest into companies like Home Depot, which have a growth rate of 19.7%, or Apple, which has a growth rate of 9.4%. These companies also have a much higher chance of growing through capital appreciation than the other ones I just mentioned. By the time that I'm ready to live off the dividends my portfolio provides, the yield I get from these investments I make today will hopefully be significantly higher than any new positions I could enter into at the time. Another good way to see how important it is for the dividend to be growing year over year is to look on the yield on cost over time. This is for ExxonMobil. If you invested in it back in 2016, your yield on cost would be 4% because the value of the stock has continued to decrease over time. So you get a better yield investing later on. The same thing applies somewhat for Main Street Capital. This is the kind of graph that you want where the yield on cost decreases over time. So the further back you are, the higher your yield would be today. Where if you invested back in 2016, your yield would be just under 8%, while today it's about 6%. With AT&T, this is the worst one of the bunch, where if you invested back in 2016, your yield on cost would be lower than it is today. You want this graph to be going in the opposite direction, where investing further in the past is providing more of a yield than investing today. And you can really see this with Home Depot. If you invested in Home Depot back in 2016, your yield on cost would be over 5%, where if you bought today, it's 2%. Same thing with Apple. If you bought 5 years ago, your yield on cost would be 2%. I'm sorry, your yield on cost would be 3%, but today it's only 0.5%. So getting the growth really makes it so what you're putting in today is much more valuable than what you could put in the future. Finally, the last lesson I've learned over the past year is that it's extremely important to start investing as soon as possible. It may be hard to start when almost every single day the markets continue to hit new highs, and the news has people come on every single day talking about how the next recession is upon us. We even saw this happen this week when the market dropped over 2% in one day on Monday. If you were watching market news that day, you would think the sky is falling and we have to start, and we would be heading into a recession that afternoon. What happened afterwards? If we look here at my portfolio, I'm up over 2% in the week. VOO, which tracks the S&P 500, that's up 3% in the last week. And this is including that large dip on Monday where we were down a lot. If we go to the NASDAQ is also doing well. It's up almost 4% in the week. So you can't just listen to what the people say on the news and just follow it blindly, because anytime if there is one bad day, you think that the world's ending. When it comes down to it, eventually there will be another recession, but no one's going to be able to predict it in any reasonable amount of time. I can make a prediction saying there will be a recession in the next 20 years. I'll probably be right. The likelihood that there isn't another recession in that time is very, very low. Every recession has been different, from the dot-com bubble in the early 2000s to the Great Recession in 2008, or the coronavirus recession. Every single one had a different cause, and almost nobody saw it coming. Of course, there's some people that were able to predict it, like Michael Burry, who made a bunch of money off of the Great Recession, for instance, but most people didn't see it coming. The best thing you can do is just dollar cost average into the market. This way you're not throwing your money all in at once in case there is a really large dip, like right here. And you're still able to buy and ride along with the market as it continues to go higher and higher. The costliest thing that you can do is not invest and have your money slowly lose value due to inflation. Finally, I wanted to go over how my portfolio has performed in the last year. As of the end of June, I've made over $500 in dividends, and I've made about a little over $5,000 in capital appreciation. While last year was definitely an unusual one, Hopefully I continue to make somewhat similar returns into the future, while they'll definitely eventually start getting closer to the long-term average of the S&P 500, which is about 7 to 8% a year. Most of my positions are in the green, as you can see here. And the ones that aren't, which are all of the red columns right here, those are either newer positions, which I'm continuing to build a position in, so I don't really, I'm glad that they're lower. I want to keep buying more. Or they're like Dominion Energy, which is just down a fraction of a percent. And if it continues to dip lower, I'll buy some more. Right now, I have a projected annual dividend income of $900 a year, which will continue to grow. And eventually these dividends will pay for my life, and in the meantime, they will continue to purchase more shares of the companies I love, which will further increase this and continue to build a bigger and bigger snowball. Before I know it, the dividends my money provides will be able to buy more than I'm able to with a job that I spend 40 hours a week working in. And those are the 3 things that I've learned over the last year while investing. I want to thank everyone for watching. I hope you enjoyed it. If you have any lessons you think that should be shared with everyone else, be sure to leave them in the comments below, and I can bring them up in the next video to make sure everyone sees them. Also, make sure to like and subscribe. If you have any questions for me, you can either leave a comment or send me an email at jacobmorrisinvesting@gmail.com, which I'll leave the link in the description for. See you all next week.